Hey everybody, I just wanted to give you all an update on what we're seeing in the build for rent business. I just came back from the ULI meeting out in Las Vegas and got a lot of perspectives. Already came into the meeting with a lot of perspectives from our own studies on our own clients. And obviously we're entering the slow season for lease ups and multifamily deliveries elevated. So overall, things feel tough right now. Concessions are everywhere, and some BTR projects in lease up have had declines in rents of 10 to 20%. Leasing paces are slower than last year. For example, on townhomes, projects that were leasing 10 to 12 a month are now leasing 4 to 6 a month, sometimes closer to 8 a month, depending. There's quite a wide variance on cottage product, horizontal multifamily projects that were leasing 15 to 20 per month are now leasing 10 to 15. One thing that's interesting, though, is rents are being pushed on renewals in most cases. Um, Not by much, but there are some escalations that are occurring, and we're not seeing that by and large on new lease ups. Little, if any, rent increase on lease ups, usually declining rents depending on the market. Certainly, Phoenix and Dallas and places like that and Austin are seeing declines. Uh, a cottage developer of ours in Florida is seeing rents down 15%, but another cottage style developer, BTR, in Florida is not seeing any reductions other than they have a 2-month free concession going on. New rental deliveries have hurt the market, especially for the horizontal multifamily kind of product, and especially in certain markets. Huntsville and Jacksonville have really taken it on the chin. We will see the apartment wave start to pass in another year, and that's going to help to make things feel better and for the performance to get better. There's a lot of sort of mixed results. In Florida, for example, we have one client that's developing cottages in St. Lucie, and they're still leasing 14 to 15 units a month, which is very strong. They have some expensive apartments nearby. I think that tends to help to support rents and drive absorption. But then you go to the other side of the state, Bradenton, Sarasota, that same builder, developer only getting 4 per month right now. So it is location dependent. Also in Sarasota, Bradenton, that's a much higher price point that can certainly slow down sales. It is a pretty price sensitive market. We're finding that a $50 or $75 change in rents can mean the difference between a fast absorption pace and a slow absorption pace. Central Florida, a mixed bag. Some projects at 1.5 a month, some doing 5 a month, some doing more. Raleigh, Durham, generally in the 8 to 12 a month range. Charlotte is mixed. Some of our clients are doing 12 to 13 absorptions a month. And in those cases, sometimes they're getting full and they're able to push rents. But we do see some in Charlotte still cutting rents on new lease up developments. So there's this mixture, right? It's a mixed bag of results. And a lot of it is explained by whether you have on-site staff or not for maintenance, the location, the demographics. Is the site too remote? Are there too many apartments delivering in that area? But things you can do to help to increase absorption, staging, we're finding helps. You have to also consider when the amenity opens. There's a client of ours that has a project in Georgia that was doing about 6 or 7 a month. And then as soon as their amenity opened, it jumped up to 11. Get the product fine-tuned at the planning stages. You don't want to come in too big or too small, can be deadly for absorption. Garages, backyards, it depends on the submarket and the competitive environment there. So overall, just a mix, but you do have to note that in some areas there's more strength than in others. And the capital, a lot of people say capital is pencils down, the equities pencils down, but from coming away from the ULI meeting, I don't find that's the case. They do refuse to bet on declines in interest rates or bet on rent growth. They do want to see everything work based on today's metrics. Um, and they do want to get more deals funded. They want to get more allocated to residential, but the deals have to look good on today's metrics. A lot of times they want a 7% untrended yield on cost. And it is hard to find deals that work that way, but I think things are going to get much better in about 18 months. We're going to see the push away of the inventory surplus of multifamily, and then that's going to start to really ease things up for BTR. We've already seen a huge drop in the number of starts for BTR, and I'll show some graphs on that here in a second. And that creates pent-up demand that's going to really balloon by 2026, 2027. So here's some slides to motivate what I'm talking about, the BTR Outlook. First of all, I want to talk, you can't talk about the forecast until you make sure you're working with the right historical and current data. So one data set that everybody seems to use, and a lot of the articles you see out there cite numbers shown here from the Census Bureau saying 75,000 starts for BTR occurred last year. That is absolutely an understatement of what is going on, because the Census Bureau numbers do not include all of what we all consider BTR. Blowing this up so you can see, and I'm underlining here the fine print. These Census Bureau numbers only include homes built and held by the builder. So they exclude homes that are sold to another party for rental purposes. If you added that in, you'd be at another 5% of single family starts. So another 40 or 50,000 starts a year. And that lines up very well with our forecast and our estimate. So here's our current year estimate, 124,000, not 75,000 last year. And then we see a decline happening this year, mostly in the second half of this year, where there's a 50% year-on-year decline, but on a quarter-on-quarter peak to trough basis, it's more like an 80% decline that we're projecting. And that's going to extend into certainly the first half or the first 3 quarters of 2025. And this is purely because of the lack of capital. If we were meeting demand, we'd still be up here in the 120, 130,000 per year range. So we're leaving a lot on the table. That means by 2026, we're going to see a lot of pent-up demand in the market. So anybody that opens a project for leasing in 2026, 2027 is going to have very little competition to worry about. And that's going to mean faster rent growth. Instead of today's rent growth, we're going to see 4 to 6% on average is our estimate, higher in the so-called rebound markets, those that are particularly stressed today because of the multifamily supply that's hitting. By 2026, the multifamily supply will be mostly absorbed, and we'll be back to much faster rent growth on BTR and faster absorption pace per project for BTR. That concludes our comments for now. Stay tuned, and we'll be back with you again soon. Thank you.